Welcome to our webinar again. This is CLIQ company. My name is Olga, and today we are going to talk about the cool technique of the trades closing, which will increase your potential profit significantly. Also about the splitting of the trades, and this technique will also help you to increase your profits. And let me remind you that our webinar is interactive, so if you have some comments or questions, feel free to ask them. Our team will answer them during the webinar. So let's go. Why do we need to calculate our lot size, or the size of the lot, or the volume of the transaction, or the quantity of lots? All this terminology will be used today in our webinar. It would seem that such a simple action, at first glance simple, raises a lot of questions, and of course we'll do our best to answer them all in our webinar. So before entering the markets, a trader should clearly understand the plan for his future action, namely, you need to determine the entry points and the level and the size of stop loss and take profit, and most importantly, the exact size of the lot which you determine to trade with. After all, the stability of your position while different market fluctuation in a trend or out of trend, and the feeling of comfort trading will depend on this action. Forex strategies for beginners often ignore such calculation, the calculation of the size of the lot, since the beginners consider it difficult and unnecessary. Most often, they try to maximize the deposit in order to extract as much profit as possible from the market, and it's good. In case that entrance to the market was correct, it turns out to be correct, and will not cause a lot of damage and loss of their deposit, which also increases proportionally as well as the size of the trade being opened. Or on the contrary, novice traders enter the market with minimum lot, thinking more about possible losses than about the decreasing or increasing of their deposit. But in this case, the harm to the account, of course, is less, however, as well as the profits. So let's consider what is it a lot. Lot in Forex is the total number of currency units in a trade. In other words, this is the volume of the transaction that you open. In this case, it's very important to take into account the leverage. CLIQ company provides the ability to work with both the standard 1 lot and the minimum lot is 0.01. On its website, you can find the available options for the leverage. Let's look at it. So if you visit the website of CLIQ company, you will go to account types and you will see that we have some options. Minimum order or size Forex lots. You can see 0.1 as well as 0.1 and all the options available. Okay, let's continue. Let's talk about everything in order. In Forex, the standard lot, 1 lot, is the minimum amount that you can open a trade with, is equal to 100,000 US dollars on the basic units. Basic unit can be any currency that you are trading. Let's suppose you open a trade in Euro USD at a price of 1.29530. It means that for opening transaction, you will need 195,530 US dollars. Neither much or less. But not all the traders do have such an amount. At the beginning of the history, the Forex market participants were only big investors. These days, market makers provide a service leverage of 1 to 100, 1 to even 200, 1 to 500. This service gives you an opportunity to open transaction with a deposit. For example, in the case of first mentioning example, deposit 100 times less. It means that in this case, in our example, you're gonna need only $1,295.03. These liens, they stay in the account actually inactive until the position opens. Leverage 1 to 100 is a common standard, but brokers also provide some other services and options. CLIQ company that has a leverage 1 to 200, which I mentioned before, 1 to 500. Liens will accordingly be 2 or 5 times less. What else attracts the potential investors is the ability to trade the fractional lots. 0.1, 0.01. Why is that? For the same reason, the variations of the leverage. The collateral amount is literally ridiculous. And this is an opportunity to vary the trade and make it more comfortable without losing lots of nerves. Let's look at it. So, as well as we have fractional lots, we also have different types of leverages. You can see 1 to 500, 1 to 25, 1 to 200. So all the options available for you. You just need to use the most suitable one. What do you need to consider when choosing the position size? The main thing when choosing the volume of the transaction is to take into account such important points as the size of the deposit, the time frame of trade, and the trading strategy, and of course the trend dynamics. Only after analyzing all these elements you can determine the best size, lot size, which will allow you to conduct calm trading with minimum risk. First, deposit amount. If the amount of funds in your account is quite large, quite big, this allows you to lower the risks significantly by reducing the volume of transactions. For example, when trading deposit of 10,000 USD, it makes no sense to open position with more than one lot. You can get quite a good profit with this money. You can sustain the correction of 20, 30 pips, even 50 pips, or even you can close the position with small losses. Your account will allow you to do that. Another thing, if you have only 100 USD, you still want to earn money, of course, and in this case, you should choose a lot of 0.1, and trading becomes more risky. And of course, you can earn less money because on average, 1 pip will give you profit of $1, but it depends actually on the brokers. Time frame, thing number 2. There is a clear tendency according to which the majority of traders who trade short time frames choose the maximum available volume for their forex trades. And after all, they consider in 1 or 2 minutes, it's unlikely the price is unlikely to change more than a couple of pips. So the risk of losing all the money from their deposit is reduced to a minimum. Therefore, the shorter the time frame, the greater the volume of the operation and the amount of leverage. This approach allows you to get the maximum profit from available funds. This type of trade allows you to increase your deposit several times in one trading session. And number 3, it's dynamics of the price movement. Usually, when looking at the currency pair charts, you can see how the price moves at a certain time frame, how many pips the main movement in the trend gives, and how big or how deep or small the correction is. The size of the correction plays the important role. For example, if it's not big or it's not deep, you shouldn't close your trade even when the next pullback is coming, or vice versa. You need to save your deposit, your position, by closing it without allowing a large drawdown of the deposit. This exact element is taken as the basis for the calculations. For example, the correction size is 15 pips and your account is 100 USD, so you can open a trade with a volume of 0.1 lots. Number 4, the maximum amount of losses. Usually this figure is taken into account only by traders who have at least several $1,000 on their accounts. Since according to generally accepted rules, a loss from one transaction should not exceed more than 2-3%. Let's take the amount of 100 USD. And the volume of the forex transaction is, as we mentioned before, 0.1 lot. It turns out that we must stop trading as soon as the losses reach $3. And of course, it's not very possible. It means it's necessary to reduce volumes several times. As you can see, there are a lot of approaches for determining the optimal volume in trading, in forex trading. Your task is to correctly apply them in relation to your own situation, taking into account all above-mentioned factors and parameters. And now let's talk how we calculate the position size or the position volume. Lots of traders do not understand what the risk in the transaction is. Risk is the amount of money that you can lose. Therefore, if a risk is, let's say, 4%, it means that your trading account will decrease by this very 4%, in case of a loss, of course. Do not confuse the risk with the size of the trading position. The point is that the pips have an indirect relationship to the risk, and it's because the cost of the pip on different currency pairs vary. The same applies to the futures and stocks. We recommend measuring the risk in percent from the deposit, from the trading deposit, or in money. This is the easiest way. There is still an important moment. Traders, beginners, we often talk about them today because this topic is quite complicated. Often trade without stop losses, and of course they put the whole deposit or even the whole life, it's a joke, at risk. They hope that they will be able to earn earlier than the total collapse of their deposit accounts. In most cases, they get quite an opposite result. Okay, we understand now what risk is. Let's talk about position size. The size of the position should be determined on the basis of risk. That's why we mentioned risk before. To do this, you need to know exactly where to close the transaction, the trade, the losing trade, in case the price moves against your position. It's highly recommended in this case to set stop loss at the beginning. It is necessary to know how much money you will lose in case of stop loss. How do we know the position size? Each trader has its own volumes of that transaction. Sometimes they can change even while one working day of trading session. In general, the volume of the transaction is determined by two factors. Number one, the size of trade deposit. Number two, the chosen trading strategy. In practice, before calculating the position size, a trader must determine the percentage of acceptable risk and the number of pips for the stop loss. For example, your trading system has the following parameters. A deposit is $1,000. A risk no more than 1% of the deposit amount for one transaction. Your stop loss is 50 pips. It's just an example. It's recommended to use the special scripts and calculation which help you to measure, to calculate the size of the position for you. One important detail. If you use a trading strategy with the fixed stop loss, for example 100 pips, and trade one instrument at a time, for example Euro USD, then the risk can be calculated once and it stays the same for the following transactions. Otherwise, if the stop loss is different for different trades, you will need to open different position with different volume. A calculator or script will help you to do that. Let's look at the example. For example, your deposit is 1,000 USD. From the practice, we know that the maximum acceptable drawdown is 30%. With the remaining amount, you can cover losses and earn money, of course. And we will start from this. It's 300 USD. On average, the strategy statistics ratio is 7:3. It means 7 positive trades and 3 negative ones. For one transaction is going to be 100 USD. This is the permissible risk of that transaction. And now let's calculate the volume of the trade. If the stop loss is on average 50-60 pips, then you can open a trade with 0.2 lots. If stop loss is 40 pips, 0.25 lots. If 30 pips, 0.3 lots, and etc., etc., etc. It means that in open position you can only have 0.2 lots. You can open additional trades and add the volume in case if the first position is already in break-even. And it's very important because sometimes you see the signal, you want to open another transaction, but you can't allow you to do that until your first position is in break-even. This is an option for the correct moderate calculation and only for one trading instrument at a time. If you work with 2, 3 instruments, you must either reduce the position 2, 3 times or increase your deposit also 2, 3 times. And you should also do it if you use several strategies with different ratios, because these calculations only for one trading strategy. Okay? And now let's consider this technique with the help, which helps you to increase your potential profit. And we are talking about the splitting of the position. You have already understood that you can open a trade with more than one lot, and 2 and 3 and even more, depending on the money management, which we actually reproduced in the previous slideshow. But you can also close the trade by lots. It means to splinter it. The position is open, as the example, with the volume of 5 lots. The first closing I conducted in 2 lots, and I have earned totally 24 pips. You can see it on the slideshow. Why did I do that? In order to fix the profit in account of possible future losses. It's recommended to fix the first profit, which will be equal to potential risk of the remaining open position, and of course in money terms. 3 lots I left for the future. Here you can consider the option of moving the position and break even, so it completely reinsures itself. But there is a time when the market is making a corrective move up to the entry point, as an example. You can see it over here, and you're knocked out with stop loss. But as soon as it's break even, you don't lose anything. And then market goes in your direction, but without you. Okay, after achieving a total profit of 40 pips, I again closed 2 lots. And on the same principle. And the last lot was closed with the profit of 57, sorry. It's over here, lots. Pips, sorry. Let's look at the example in the market. Okay, so we opened position with 5 lots. And the first we close one lot, we have earned 60 pips. We left the rest of the lots for the future. The second position with 1 lot was closed with 120 pips. The third position with 200 pips, also 1 lot, and the remaining 2 lots were closed with 300 pips, 300 by 2. Let's calculate how much we get actually totally. Okay, so totally we get, it's 60 plus 120, 180 plus 200, it's 480, and 300 by 260 is 980 pips. But of course you can say that actually we can earn much more money because it's 5 pips, and market has given us, these 5 lots, and market has given us 300 pips, but actually this methodology and this technique of splitting up the transaction will help you first to save your deposit, and second to increase the potential profit. Because you might know the saying, slow and steady wins the race. It's about us. And we recommend a systematic approach for the forex trading. This also concerns the creation or the development of trading systems and the management of your capital or the size of your position. And the systematic approach makes our life much easier and of course our trade much easier. In no case should you allow the situation where in one transaction you lose $50, in another 150, because in the third transaction you can lose everything. It's important that the losses in each transaction are equal. With this approach, it's very easy to calculate the probable profitability, the maximum drawdown, and the maximum profit. A lot of beginners choose the size of the position by eye. In one transaction, 0.1 lot, next is 0.3, and next is 0.5, etc. This is a very dangerous habit and can lead you to the loss of your deposit. You shouldn't do that. And remember that for a trader, it's important not only to earn and also but not to lose or to save what he has already got. And of course, if you want to know more about our trading techniques, our trading tips, you can visit the site of CLIQ company and choose any education course that suits you most of all. CLIQ company and I wish you the very successful trading and excellent profits. Stay with us. Thank you very much and have a nice day.